Welcome to the Dividend Talk podcast, episode 221. 4 European dividend aristocrats that are not talked about enough. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How are you?
I hate that question.
I know. And that's why I keep asking it.
You did this already 221 shows. It's so funny.
I mixed it up once or twice to put you off guard. But
hey, how are you doing, Derek? Tell me.
me, I am tired. A lot of traveling with work. I'm only back in the country a couple of hours, and I'm off again in the morning. That's why we're recording this on Thursday rather than a Friday. It's been quite a quick turnaround, so it's quite a long. Do you know what? I don't know how you feel about it, but lots of people think traveling with work is a novelty and it's great because you can like buy dinners on company car and you get everything paid for. But sometimes it's just tough. It's just hard.
If you're single and you haven't seen a lot yet from the world, I think it's interesting because how often do you get to go abroad without just for a weekend or something like that? That's often a luxury. So if you can do it for work and therefore maybe spend an evening somewhere in a foreign city, that is nice. But when you have a family with kids and you know that your wife is having all the troubles, I don't know, of looking after a sick kid while you're gone, for me it really creates this kind of feeling like I'm punishing my wife or something like that with travel, right? So that's why I don't like it. But hey, I must really salute you because I know that you came home just to record the podcast. I mean, you've been spending your day half of the day on the airport in an airplane just to spend time with me on the podcast. I mean, I find it. I mean, people don't know that maybe about you, but I think it really shows your dedication.
I mean, stay in Milan or record a podcast. I think the podcast is
in Ireland.
As soon as the plane landed, it was raining. It was cold. It was everything. But I look at traveling. It is what it is. I've been to Italy now. This is my 5th time this year.
Mm-hmm.
I know these cities quite well. I don't usually. Some people stay over the weekends and do what you do. They go to Venice and Florence and all these other areas, but I've got a wife and kids at home. It's not fair to them. So, yeah, I'm not going to complain. I'm saying like I'm complaining. I'm not. I'm probably just tired and grumpy. But yeah,
I think myself and thousands of listeners are very happy that you took the time, especially for us, to come back and share your opinion about at least 2 out of the 4 European dividend aristocrats that we think maybe we should cover more, or people should more talk about. So thank you so much. But hey, I will take you out of your suffering and let's go straight to the news of the week. And also Alexandras Skirnikovas, Alex, we had him on the podcast one time as a guest. He is one of our super moderators as well on the Facebook group, very engaged there. He also asked us about ASML in the Investor Day presentation, what we feel about it, also what are the main changes in strategy outlook for the company. Specifically also, of course, the stock price responded quite a bit up. Now,
Okay.
I've been, as a Dutch person, I've got the benefit of reading also the Dutch news, and ASML gets a lot of coverage there because when ASML goes up, the entire Amsterdam Stock Exchange goes up. That's the weighting that it has. And the biggest takeaway from it is simply that analysts are really relieved that the company is maintaining its long-term objectives and the outlook. That's just really the best one, because there was a lot of fear that due to all the geopolitical situations that we're seeing, that the company would need to slash the outlook. Yeah, and that will probably trigger all the valuations to go down and everything. And they maintained it. So I guess this is why analysts are happy, investors are happy, and buying it again. Because there's some, I guess it is a bit de-risked in their opinion.
Yeah.
I haven't read all the changes in the production or what their plans are for EUV. I really need to sit down and digest that. That's typically for me for a cup of coffee in the weekend. A bit too short day for that for me. But what I was happy with is that they continue to commit to return a significant amount of cash by growing dividends. What I don't like so much is that they also mention in the same sentence share buybacks. Why not? I think that ASML is just very much priced for a lot of expectation. I think the buyback yield is very low. I would rather them to focus on a AAA balance sheet, just build up cash, use this for, I don't know, whatever acquisitions you need to do, because I find the share buybacks not so meaningful for a company like ASML at these prices. So I rather, let them grow the dividend. The dividend also, I mean, you don't buy ASML, I think, for the dividend at this moment in time. I own one full share of ASML just out of appreciation for the company. But if you do the math, and the company would need to grow by the dividend by 10% over the next decade, you will still not go far, because the company is currently yielding 1%.
Yeah, it's too low.
It grows 10% the dividend each year. We're talking about a 2% yield after 7 years. Yeah, and if you look at the last 3 years, it went from €5.50 to €5.80 to €6.10. Of course, around COVID, it doubled the dividends. So if it does that more often, but I don't see them doing it so quickly, because that was kind of an outlier in the historical trend. So I don't invest in it for dividend. It's just like one share as a token of appreciation. I could maybe buy one time a second or the third share, but it would really need to go up to the 2.5% to 2.8% yield for me to really find it interesting. But hey, 18 years of dividend growth, not too bad.
Not too bad. And I suppose the underlying message is that they're still on track with their long-term objectives, and I think that's what the market.
Yeah, and a growing underlying margin, because when the company got punished over the last 2 years, it was typically because they were not able to hit their gross margin targets. Yeah, so that will be interesting. And those are typically providing the dips.
Yeah, nice one. So some nice dividend increases this week.
No, just one.
Just one. Oh, just one. The rest of them are dividend cuts. So just one, and that is Siemens, and they hiked their dividend by 10.6%. Did you have a look at their earnings?
No, it's the full year earnings now. They always report mid-November.
Yeah.
So I haven't had a chance to look at it. It's really been too short day for me. But 10% again. Remember, they did kind of a dividend cut, which we didn't really count as a dividend cut. I mean, they are not for that reason in Noble 30 index, but the dividend cut was because of a spin-off.
Yeah.
Now, if Siemens Energy would have continued the dividends at the same amount, we would have probably left it in there, because that would be the same as Abbott spinning off AbbVie and companies. Sorry, usually people do reward Abbott for the dividend history, knowing that it's spun off AbbVie. But that Siemens Energy didn't do that, so that's why Siemens is not in there. But yeah, I mean, I mean, people that listen more often to us, they know how much we appreciate this company. We see it as one of the last industrials in the world that is proving, that's effectively showing a middle finger to General Electric and 3M about how they screwed up, and how Siemens has been able to keep an eye on the trends and not on the financial engineering. And yeah, it's just really just impressive what they are doing, I would say, through the cycle.
Yeah, yeah, it's really, really good. And I think, I don't know if we did a deep dive, but we spoke about them quite a bit. And one of the areas was obviously electrification, which I think is a huge growth driver, and that has really drove these results this year as well. I haven't gone through the full list. I just browsed over the headlines, but electrification seems to be doing well. Automation, surprisingly, is challenging for them. I was expecting that to be a little bit better, but I mean, they're generating so much cash flow. They're over 5 billion this time, and 10% increase out of that. So
Yeah.
my only regret, I've said this again, when they dipped under 100, we were kept saying it. That should have been, never mind this AT&T under 30, it should have been Siemens under 90 or whatever it was at the time.
Yeah.
That's what we should have bought.
Well, I bought. You
Yeah,
maybe didn't. Or not enough.
not enough.
I can underline the not enough. I can
Not
underline the not enough because it's still a relatively small position in my portfolio, which is really a pity.
Shame.
But I can see that it has unrealized gains of 100.3%. So I doubled my money. I have a yield on cost of 5%, and the current yield, I didn't put the dividend hike in there yet, is 2.5%. So not enough bought. But when you start investing, you don't have so much money. Maybe now I've got more dividends to reinvest. So no, what can I whine about?
Yeah, true. And look, for those of them with the automation business, I'm doing my best to help that. So like, we have this big design, and all our components are Siemens that we're using, even down to cyber security. It's all Siemens. So I'm doing my best for the automation part. Hopefully that will come back up. But no, it's it. I would love for that to be like a foundational European company for me in my portfolio.
Yeah,
I really would. But look, valuation has to come into it as well. But nice hike. Unfortunately, we've got 2 dividend cuts. Now, I don't own any of these companies, but the first one is Baxter International, cut up by 41%.
Yeah.
And then,
I mean, for many people, it doesn't come as a surprise. And the second one is Burberry. It's listed on the British London Stock Exchange. They are suspending the entire dividend, and we got some questions about Burberry not too long ago as well, right? Because people are looking at these luxury stocks. Honestly, I got a request from a premium subscriber to look into it, so I started yesterday doing my due diligence, and I felt like, this dividend doesn't look too safe. And today I read that they suspended it. Seemingly they did this already in July, but I didn't go that deep into it. Just looking through my screener and everything, it became already clear that this is a company in trouble. Yeah, I thought like, okay, but I'm not going to make a stock card now. Let's wait for the earnings, because otherwise I need to change it again. And I already my dashboard said already like, this dividend is not safe. And yeah, well, a day later I know why. Yeah. I know better why.
you didn't have to wait too long to see that thesis come to life.
Exactly.
But Burberry was always a strange one for me. I know growing up, it was popular in the UK, more so in the UK than Ireland, I would say. But it fizzled out really fast, and I kind of just assumed it disappeared. Actually, I haven't heard about it for a while. Only you spoke about it today and before, and I seen on your Twitter that I was like, oh, Burberry were still around. I just thought they disappeared. But
what is interesting, when I was doing some due diligence yesterday, and I stumbled on an article where it was written about how shameful it is, how much of clothes Burberry just takes back and never sells and just destroys to keep the brand up. But then I read the second article, it's like, yeah, no wonder Burberry has lost its mojo, because wherever you walk, you see fake Burberry around, and the company's not fighting it enough. that's really interesting, right? So it really shows that these luxury brands, they really, really benefit from scarcity.
Yeah,
Because if everyone could own it, there's nothing luxury about it. Yeah, Burberry is not Nike, yeah, or something like that, or Adidas, which
yeah,
anyone in the middle class can easily own. Yeah, a few sneakers. No, they benefit from scarcity, and I think other luxury brands just do this better. Think about Hermes. Oh, okay, that you have luxury and you have luxury. Yeah,
yeah. That's elite
that's
luxury.
next level. Yeah,
Yeah,
yeah.
but the point remains the same. Yeah, I think you're spot on. Burberry for me, 100% right. Burberry, Fred Perry. I don't know if you remember Fred Perry, but growing up, they were the two, say, designer brands that, say, middle class would want to own. And
Yeah.
you're dead right. There's plenty of
Yeah, with
knockoff versions
Burberry, I
going
think
around.
about these blonde ladies on Ibiza that don't have money and want to have a holiday, and then they buy this stuff on the bazaar somewhere.
Nice one. So, for European dividend aristocrats, and we've taken this from your famous, I would say now famous, Noble 30 index. So we picked four companies that, well, I think we don't speak about enough.
Mhm.
And because we're on Burberry, I'll stick with the UK, and I might start with Spirax, the Spirax group. And I think you have them down as Spirax-Sarco, I think, which was the old name, but they've
Mhm.
now call themselves the Spirax group. And why they have that now is because they're not just steam anymore. They've also got this fluid technology in Watson Marlow's. So anyone that knows anything about Spirax, basically they offer steam or electric thermal solutions. And
Mhm.
why is steam important? So steam is probably the most intrinsically safe form of sterilization that you can use. You can't ignite it, you can't blow it up. It doesn't damage any products. It's safe. It's just intrinsically safe, and that's really important. It keeps costs down, particularly if you are in the medical or pharma industry, which is the industry that we're in, that I work in, and I know that we have to use steam to sterilize our products now. I won't say what products because you'll guess where I work if I say that, but it is really, really commonly used. So I think it has lots of growth based on that. It's needed. It's 100% needed. It is a cyclical industry, so it's going to follow your industrial production demand, and you'll see that varies. But Spirax typically outperformed that over the last 20 years by double the amount. Even when times when that's low, they've done really well to stay above that by double. So that's their goal. They call that out in their capital markets. They want to at least double the returns based on industrial production, and they've done that in the past, and there's no reason why they can't continue to do that. But it's important to know that because their dividend policy, like many or most Europeans, is based on their underlying earnings per share. So if that's growing, the dividend will grow. If that's not growing, they'll keep it stable. But always important to know, I think, the dividend policy of a company. But they're in your Noble 30 list. That means they've grown it for a significant amount of time. So it's not really, really in danger. In terms of revenue, look, they've been growing quite, I would say, well over the last 10 years. It has stagnated in the last 12 months. You'd notice their share price has dipped over the last 12 months. So they have some challenges. And we spoke that they are a cyclical company. They're kind of in that cycle. So revenue has kind of tailed off. They generate enough cash flow. Their dividend cover is 2x at the moment. So that gives, if you were to convert that to a payout ratio, it's around 50%, which is decent enough. So the main, say, growth drivers, one of them is acquisitions. So they have a lot of acquisitions. What has that done? It's added a bit of debt to their balance sheet. So back in 2015, it was about 80 million. Now it's 876 million. So they've 10x their debt in that time. Now, it sounds like a lot as 10x, but their debt to equity ratio is still, I think it was, I'll have to check my notes, but it was around 90%. So not astronomically bad. They can cover it. Their balance sheet is relatively stable with that. But these acquisitions, what's happening with them, and one thing I wanted to highlight on them is that it has added goodwill is now 71% of the balance sheet, which is, consider that like a risk, it's too high. But also as a result of that, the return on capital investment has nearly halved over the last 10 years. And that's based on them trying to integrate these and the synergies, the higher costs, operational inefficiencies, and they're struggling to really maximize the most out of these. So the return on invested capital is now 14%, where it was 30% 10 years ago. So you can see they're really struggling, and their margins are under pressure as a result. But overall, I think long term, I would not have real concerns with this. It's in the lower part of its cycle now. Dividend yield is coming down to a reasonable level, I would say. It's nearly, I can't remember what it was last time, but it's around 2.5%. Yeah, 2.5%. So it's getting close into an area where I would be interested in looking at it. But definitely, I would recommend looking at this company. I think it's one that you don't get too many opportunities to buy at a decent valuation. It always trades at valuations that are quite high. And given the little bit of uncertainty and the cyclical nature, and it's on the downtrend, I would recommend checking out. And I think Watson-Marlow, I haven't even touched on Watson-Marlow. Watson-Marlow are these pumps, precision pumps, aerostatic pumps, and that's really added another layer. And that there's a lot of growth to come with this company. But yeah, definitely a company that I looked at in the newsletter, and it's on my list now that I've studied them. If they hit the 3% yield, consider me a buyer. But it looks interesting.
Yeah, and Spirax has always been a company that intrigued me, but only now that it's trading at a 2.5%, it is really having my interest here, because otherwise it was not even worth it. And I must say, I couldn't have done the analysis that you have done, because you understand the engineering behind it and the product portfolio. I don't. So it was really refreshing to read your deep dive on this, and it just only helped me in understanding the company much better. So well done. Well, hey, let's see. Yeah, if you say 3% yield, it needs to drop still 20% in share price, which, if we take the last year trend into consideration, shouldn't be a problem. So, crossing my fingers for you and for myself. Total Energies I want to talk about, because we speak a lot about oil and gas companies here, like Shell, ExxonMobil, sometimes Chevron. I did a deep dive on BP last week in the newsletter. But we don't really talk about Total Energies, which is the largest energy company from France, at least oil and gas company. But I don't even know if they want to be called an oil and gas company, because they changed their name even at the time into Total Energies. Yeah. What I find really interesting in the company is that I think they have a really good understanding of the world and the needs of the world, the energy demands, how energy contributes to a better life for people. So think about the people living on the south of the equator, mostly Africa and such. If they start becoming richer and richer, they will need more energy to improve their lives. So they clearly have a good understanding of the general evolution of society as what the trends are. And then they are showing, like in their investor relations deck and their strategy, like how they want to address it. And of course, they really want to also focus on low carbon energy. This is pretty much in line with the climate agreement. We see that with BP. We saw it with Shell until the new CEO came. Of course, BP with the new CEO is also a little bit more like, back to black. Yeah, let's call it like that. Total Energies is not there yet, from what I've observed. And I actually wonder whether they need to, because they seem to have a relatively solid strategy. Like BP and Shell, I think they went too quickly into this. I feel like Total Energies is balanced. They have never really thrown oil in the bin. They don't have a shame for being an oil company, which I felt a little bit more with Shell and BP at the time. So they do expect until 2030 a natural decline in their oil by 4%, but then gas they expect an increase of 1.5%, and then they really have high expectations for wind, solar, and hydro because it's still a relatively small portion of their portfolio, and that's where their investments are. Interestingly, they have also nuclear in their portfolio. They don't expect too much growth there, a little bit. But, we know that France loves nuclear energy, so they have also a bit there.
Yep.
But for now, investors just should realize that until 2030, just expect oil and gas to be the energy source that will drive their free cash flow, nothing else. Integrated power, the second business unit, they hope it will be positive, free cash flow positive by 2028. So don't expect a lot there, but they're investing there for the future, setting themselves up for the future. And it shows again, like, how difficult it is for these companies to transition, because they need to invest a lot of cash flow at such a low return compared to oil and gas. Yeah, but effectively what Total Energy is doing is like it's trying to bet on two horses. It makes sure it's continuing getting the maximum out of their oil assets. They continue to also invest in oil assets. So some projects are coming live. They made this year some big investment decisions as well for funding. So I would say generally, yes, they are still pretty much focused on oil and gas, but they're also trying to bet because they know, like, if at a certain moment there will be a quick downturn in oil for whatever energy revolution is going, they are kind of playing there. Yeah. So they won't miss out. But yeah, just expect lower performance because of that. Yeah. Here, because if you start mixing decent performance with a non-profitable performance, your overall performance goes down, and that's what we're dealing with here.
Yeah.
And when you talk about that, about their capex, just giving a feeling, right? About a third of their investments is going into the maintenance of their brownfield assets and everything. A third of it is going into new projects. Well, actually less, maybe 15-20% is maintenance, 30% is new projects. Then another 30% in integrated power, and the other 20%, let's say, in LNG and gas. Yeah, and they're talking about 14 to 18 billion in capex through the cycle. So that's a lot. Yeah, and it shows you that a lot of the capex is really transferring to low carbon energy sources. And with that, in their integrated power business, they want to have a return on capital employed of at least 12%. So at least this is good. They are having a bar, yeah, and because they are not just throwing money at the wall and hope that something sticks. Yeah, that's what I like about Total Energy. And when I studied BP, I didn't get that feeling. I got a lot of naivety. A feeling. I have this less with Total Energy. I've kind of got a feeling that they understand the situation and are realistic there. But 70% out of this integrated power will have to come from renewables and storage. So think about wind energy, which is a lot.
Yeah.
So if you think about it, they expect to be integrated power to contribute a little bit of cash flow by 2030, but it won't be a lot. Yeah, really not a lot. So from that point of view, the company yields today 5.6%. Technically, it cut the dividend by 1 cent. I think in 2020, 2021, we didn't count it as dividend cut, rather as a bookkeeping error. But for the purists under it and under us, this could have been seen as a thing, as a cut. But for 1 cent on a 266, I didn't want to throw it out of the Noble 30 index. It bloody annoys me. But that's someone who loves nice numbers and nice growth charts, right? But it's been doing quite well again. It had to keep the dividend quite moderate, but then over the last 2-3 years, it really started raising the dividend again because the cash flow allows for it. And we've seen that with other companies again as well. doesn't have the strongest balance sheet uh, in the oil and gas industry, but is definitely with the top players there with the balance sheet. Credit rating of A1. They have enough oil in the ground to still play with us for a decade, even if they wouldn't invest anything anymore. And yeah, generally speaking, I think it's a solid company and deserves its place between the 5-6 oil majors.
Yeah.
So yeah.
I just pick up on the part you said they're not ashamed to be an oil and gas company, but they've changed from an IOC, integrated oil company, to an IEC. If I'm correct.
Yes, yes,
The
yes.
play on
But the
energy.
difference is the narrative. If you read BP, all this stuff, the strategy that they had in place, I felt like it was a pipe dream. Maybe this company had a bit of shame still from Deep Horizon, that employees feel shame for it, that they have been pushing for this stuff. Total Energies, I see more the French engineering in here. Probably very logical, very analytical, but also understanding what the Paris Agreement is about. But I have a feeling that they have one of the best strategies switching to new energy, and they're not fooling. They're actually transparent, yeah, because you see them having nice pictures where they show that they are cash negative on these investments. You don't see that with a company like BP or Shell at the time. They show just nothing there. They just say we're doing these projects and we want this and we want that. And so, and I like this transparency a lot from Total Energies. It builds me confidence that they're not greenwashing.
Yeah. Yeah, I think the energy transition is one definitely. Look, I find it fascinating, and Europe has some really ambitious targets.
Yeah.
2030 is a big year, and obviously 2050 when they want everything nearly on renewables. So, yeah,
the oil major that is able to transform into new energy entirely while remaining the
profitable
free cash flow, yeah, deserves a Nobel Prize.
Yeah,
because that's the challenge ahead of them. It deserves a Nobel Prize.
Quite a nice company, and you did a nice comparison on the newsletter about the super majors that I would call them, and I mentioned to you afterwards, after reading it, it's Total Energies would look to me the most interesting on paper to go after seeing that, and that was even above Shell, and Shell looks quite impressive, always looks impressive, but Total Energies kind of stood out as, yeah, it's a company that deserves a little bit more love and attention than what even we give it on the show.
Yeah, well, I'm still like a Shell fanboy compared to Total Energies, because I think Shell has just it's more focused on shareholder return and the cash flow. But that's an opinion. Yeah, I just presented the data to all the people that are reading the newsletter, and the ones that are really loving pure oil and gas, they will probably be more interested in the Americans. If you think about shareholder returns or shareholder focus, I feel Shell is standing out there. And to your point, if you look more at what we just discussed, then Total Energy also looks good. So I think there's something in it for whatever the investor looks at. Yeah, but it's always nice to do this analysis, because benchmarking them with each other is actually, I think, the best thing to do with oil majors, because on its own, it doesn't tell the full story. You know, this is different than technology companies or consumer staples, because there you need to focus on many things like the market, the products, whatever they do. But with oil and gas is simple. Yeah,
it's the same product. It's the same.
Exactly.
Nice one. So the second company I chose, I just realized I stuck with UK companies again. I'm kind of getting a little biased towards UK companies. There was a couple on the list, but I stuck with BAE Systems. And I know I spoke before a little bit about these, and full disclosure, if it was a choice between BAE and Lockheed are a much bigger company, and I would probably sway that way. But in terms of European companies, and if you want exposure to defense companies, which is technically classed as a sin stock, I think BAE Systems is quite a good choice to look at. Their history is actually quite fascinating to look at. I think it's over 450 years old. But when you go back, you see the company started, and that company that started back then is probably broken up into about 50 different companies now. But it's BA System has it on their investors page. There's a graphic. It's hard to even read it sometimes. You have to really scroll in. It's so big. But yeah, 450 years old and about 20 or 30 companies offspring from that. I think it's important to know with these, the biggest sector is AR, so planes. And I had the, I wouldn't say pleasure, but in New York, they have all these types of planes on display, and they are known for their Typhoon and their Hawk. They're the two that BA Systems are known for. And actually, I've seen them in person, and they are really quite impressive and a little bit scary looking, I have to say, like whatever way they design them. But overall, air is 32% of its revenue, so it's quite high. Surprisingly for me, though, I would have thought that the UK and Europe would have been its biggest market, but it's actually the US. I mean, the US budget on defense systems is crazy, nearly ridiculous at times. Not only is Lockheed their biggest supplier, but now BA Systems are our biggest supplier of their aircrafts and so on. So that kind of blew my mind. And you have to bear in mind that BA Systems are only the 6th largest by market cap and revenue in that field. Boeing, who I wouldn't class as your classical defense company, I know they're ahead of them. General Dynamics are ahead of them. RTX are ahead of them as well. So they're only number 6, which I was quite surprised, but I thought they would be higher given their European base. Maritime then is their second highest segments. That's your submarines and your naval ships and so on. That's 22%. They do a lot there for the Royal Navy, as you'd expect in the UK, which is quite strong. But also Australia has a big chunk of that as well. So globally, they're diversified in terms of revenue. They have some Middle Eastern countries as well that they do. So I think globally diversification is key. Where's the growth? Well, I think we spoke about this on the show before, especially I think what happened in Ukraine made Europe maybe sit up a little bit and take notice and know that they've got aging materials and stock and aircrafts and so on, and there's lots of budgets going around. So that market, the global market, is expected to grow at a CAGR of around 8.2% to 2030. And given that they are top 6 companies in the world, you would imagine that those companies will, I'd say the top 10 companies will probably get a large chunk of that. So Dividend Aristocrat, they've been increasing their dividend for over 20 years. Again, they have a similar dividend policy. They pay out from their earnings. But yeah, like I find I've no issue owning Sin stocks, but I find it quite depressing when you're looking at growth of companies like this, because it's usually not good news. It's always for a reason. It's around protection and maybe wars and so on. But that's the reality we live in at the moment. And I think there's definitely some tailwinds for the next 5-6 years. They have a lot of back orders. They've quite significant orders in place. So yeah, and yield, I think it's again around 2.5, 2.6%.
Mm-hmm.
But in terms of dividend safety and yield compared with Lockheed, I think this one is a better pick from that point of view.
And you know, European companies need to increase their budgets, right, for defense.
Yeah.
Do you think it's a bull case that European companies would prefer probably an ally that is in Europe, like buying from a British company over an American company? Or
I don't get that feeling. I don't. You would like to think so, but I think when it comes to defense, particularly if you're buying aircrafts or submarines, you want the best quality. And if their strength is obviously the aircrafts, and whether it's Europe or America, they'll buy for them. But I don't get that feeling. Like, I mean, I wouldn't class some of the Middle Eastern companies as allies, but they still sell to them. I think countries will buy the best product.
Yeah, but I think moment. For instance, where would I don't know, Austria buy?
Yeah, Would BA be the most? Yeah, but I mean,
How
the
much?
big
How much do European nations trust the Americans? I
probably
mean,
not
we
as
live in an American empire, right? But how
yeah,
much will they trust the American
yeah,
over the Brits?
probably not as much as maybe 20 years ago. But
Yeah,
then how much would Austria trust UK? They
yeah.
might have
There's probably
some
too much
issues.
geopolitics and
Yeah,
deals
yeah.
being made at play here. Yeah,
Like it's a very, very. I find this a very hard sector in terms of if you're going down to that level because
yeah,
it's like there's no. It's like football players. There's no loyalty. There'd be
yeah,
people that buy and sell and
yeah, yeah, yeah,
to different people, but yeah, unfortunately, it's quite grim when you think about the growth. Is because of what happened in Ukraine, kind of
yeah,
propelled a lot of European countries to go right. We need to up our stakes here and start reinvesting a little bit more in defence. But I mean,
yeah.
at the end of the day, we're dividend investors and we're here to make money. And this is a
Yeah, for
company.
me, I'm very reserved in this. I don't see myself quickly owning one. It's not that I would say no, but there's a moral dilemma. It's a moral dilemma. Yeah,
Yeah, yeah, 100%, 100% agree. And I remember when I was doing the growth
yeah,
prospects of it, and I just remember having that feeling going,
yeah.
this is quite sad. And so like just the moral compass of it all
Yeah,
is
but that's why we spoke about it before on the podcast. I really liked when ASR published their stance on investing in the defense industry, saying like, "Hey, but you know, shouldn't we also support governments like the Netherlands, where we are domiciled, in the ability to defend itself?"
yeah,
Yeah, so it's we are probably born and raised and educated like weapons are bad, things are bad because we were not aware of the threat anymore, thinking like, well, in the European Union, it's kumbaya all together, right?
yeah. But
Well, now it comes closer to home, and suddenly the things we took for granted are not the same anymore.
yeah, yeah. And look, there are morals, but you can't be naive
Exactly,
either.
exactly.
And if the shit hit the fan, the first question you'd ask is, why
Where's the
didn't my
gun?
government do more to protect us? So like
Yeah,
so it's
yeah, yeah, exactly. But yeah, exactly. Because we would not quickly look at ourselves and how we voted. Yeah, we would always blame the other.
exactly
But anyway, I don't want to go into politics and accountability of people's things. That's not what this show is about. Yeah, interesting pick, and maybe it's also because of the sin profile that we don't talk a lot about it. But if you look at the history of BAE system and the technology, that they have invented over the history, it's quite impressive. Yeah, and
yeah.
it really contributed a lot to the safety of the European continent. So also how we can look at it. Yeah, the fourth one, unfortunately, is also a British one, and maybe I mean not by design, because I really don't care. The French one and a British one. I mean, what a combination! They won't eat each other's food, but
Uh, I enjoyed that. It's actually so true. It's funny.
yeah. So I'm sorry. I hope no British and French people are taking this as an offense. I want to talk about, is it Sage or Saga Group?
So so I would pronounce it as sage.
Sage.
Yeah,
Okay, Sage. So Sage Group is from Newcastle, out of the UK,
yeah,
Newcastle of all places. The company was founded by someone called David Goldman in 81 there. And it's in the business of enterprise resource software, yeah, ERP.
yep.
And, it was a typical stock market darling, in 2000, going hyperbolic, like literally in a few years from under the 200 pence to almost touching 1,000, dropping entirely back again to that period. I mean, you see it like as a big middle finger on the chart. It took them all the way till 2023 to reach back their all-time high again. So imagine having bought there, you lost 20 years. 20 years, unbelievable. But it also had a quite recent drop not too long ago, of the last year, but it's recovering a bit again. But if you think about it, what they actually offer in services and such, right? So we're talking about ERP, but we're talking here about ERP for small and medium-sized enterprises. So you could say it's a competitor to SAP, but from the other side, you could also say it's not. Yeah. So they I would say focus on, like, for instance, think about when you manage with customers, payment reminders, payment processing, invoicing, governments, tax determination, compliance reporting, pay slips for employees, these kinds of things it does, but focus on small and medium enterprises. This is also where I see a bit of an issue there, or a risk, because we have all these fintech startups nowadays. Yeah. So I really wonder, like, how sustainable their business model is. And if anyone understands this market really well, please reach out and let us know. Because if you see what's all going on in the fintech industry and all these point-to-point solutions to support small companies, I wonder how sustainable Sage is. On the other hand, Sage has been doing really well. It's on fire over the last 2 years, mostly because of their transformation into the cloud. Yeah, so they really went full on to the subscription model, and it has been doing them really well. We've seen this with ERP with SAP as well. The transition to the cloud just allows them to charge more to their customers. Yeah, it's simple as that. And probably when you're on the customer side, you see your cloud billing go up double digits as well. And at a certain moment, that will have to lead to cost savings. And then we'll see what it will do to the companies like ERP, Amazon, and Sage as well. And it's interesting because you really see that their earnings and free cash flow start to pick up really in the last 1.5 year. Balance sheet wise, I would say company is, let's say, a debt to equity slightly above 100%, but I would still say okay-ish. For my liking, I like it a little bit lower. But the company has 36 years of consecutive dividend growth. The last few years, not so strong, but they have a progressive dividend policy. So I 36 years of dividend growth, actually since its inception as a public company. They've been growing the dividend, have been growing over time. Even though they peaked in 2000 in a hyperbole, it didn't affect the dividends. It probably more drove the emotions of the shareholders than the dividend income itself. So it's quite a unique company, I would say, in small business. I just have really this question about what is their sustainability behind the business model. Are new startups and small companies, are they going for Sage or more to the fintech startups? And let's say, what is the company just milking out now the companies, the existing customers with cloud bills? Is that what they're doing? That's what I don't get a feeling for, because I didn't do a deep dive. But shareholders have done really well if they bought something, let's say 2 years ago.
Yeah. So you don't know this, but when I had my own business,
yeah,
Sage was my go-to on that. So HR, payroll management, accounting, it was a lifesaver. And you mentioned SAP as a competitor. I would not see SAP as a competitor, because that's probably more large scale.
Yeah. I mean, it's in the same industry, so you may think it's a competitor, but they don't compete directly.
Yeah, they don't compete. The other competitor was Xero. I think XERO was the other one, and I've tried both, but Sage made everything actually so easy. It saved me so much time, and I'm thinking as a small business, which I was, I would see no reason to change them. Once you have them and you have your processes in place and you have a payroll in place and you have your accounting in place, it would cost me more time to change. So I can definitely see why small to medium sized businesses would go with them. When you get to a larger scale, SAP probably make more sense. But there's lots of, think of all your shop owners, your post offices, your chip shops in the UK. There's a lot of them.
they need a low cost solution that works, and
Yeah.
Sage definitely get that. But yeah, as a product, I thought it was fantastic. I would love for you to do a deep dive on them and see what feeling you get
Mhm.
for the company. I feel I'd be too biased towards them, giving my positive experience with them. But yeah, I have to say, as a customer, I was more than happy, and seeing that dividend growth and actually the growth they've experienced. I can't believe I didn't look at them in that way
Yeah.
before. But yeah, I'd say it would be a really good company to dig deep into and see what you can uncover.
Okay. Maybe I will consider that.
Yeah. Okay, listeners' questions. And we start with dividend controller. As you can tell, I've stopped saying his name in German because I always screw it up. So dividend controller it is, but it's a very good question. What's the biggest setback you have experienced in life outside of investing? And did it teach you something that you can use when investing?
This question is a bit too private for me, so I will not respond to that if you don't mind. But what I learned from it is that when you fall down, you can always step up, and your willpower is what is the main differentiator. I truly believe that there's a quote like, the difference between the impossible and the possible is a person's determination.
Yeah.
And that's what I think. Where there's a will, there's a way.
Yeah, I think everyone goes through struggles. I told my story on this before, when at one time you hit rock bottom, you go broke a little bit, and that kind of shaped probably my investing, but also having something behind that. So there's always like an emergency fund or something, that I'd never leave myself get into that position again. I think that was quite important. I think when I was young, you've heard of the boom, the housing boom and stuff in the Celtic Tiger in Ireland. When I was 18, 19, I was earning ridiculous money as a tradesman. I wish I saved more of that back then. I thought, you think it's invincible, you have it for life. So, but that's what I learned. To always have something behind you for a rainy day, because that rainy day will come along sometime.
Yeah.
The World Investor has asked us, are we finally buying Bitcoin?
No, something with circle of competence. I know, like, look, hey, we've been talking about Bitcoin since when? 6,000, 7,000, something like that.
Yeah.
Or not talking, but we've been doing a podcast since then.
Yeah.
Well, went
90,000 it is
15 times since then.
Yeah.
So, they're the ones that can laugh at us. Yeah, and good luck staying poor.
And they deserve it. They took the risk. In fairness,
exactly.
They took the risk.
I will never blame someone for making money. There are so many paths to take money. I'm just more the conservative, boring guy, and Bitcoin I just don't understand. And maybe I'll figure it out once it is as gold, and then I feel like there's no return to be made on this. So, and maybe I will hit my head against the wall, that my children will say, like, Father, you were in investing, and you couldn't even buy like a Bitcoin, or let's say something of Bitcoin in 2024. Yeah, after the whole run-up, you couldn't have seen it.
Hindsight is 2020, but I think the world investors asking the wrong question. I think it should be Dogecoin, because Elon Musk is now in cahoots with Donald Trump, and he's going to pump this to the moon. I think, like, it's incredible what's going on in that side of the world. But I mean, Dogecoin probably jumped probably more than Bitcoin has. I would imagine. So yeah, I mean, look, crypto is it is what it is. Some people do really well out of it. Some people will buy high and sell low. That's just the nature of it. But it's the volatility of it. It's been, you can argue stocks are the same, but it comes down to circle of competence and what you really know. Do you really understand the risk? And at the time, I had one full Bitcoin back in the day, and I wish I held it. I really do. But there you go. Life is life. You learn, living, you learn. Jan Racker has asked us about AI tools. Do we use any for call transcripts, financial reports, understanding the sector, and have we any tips?
I tried it. I'm not satisfied. I tried, for instance, to load a quarterly report into it and then ask, like, what are the top 5 things I should know? And then I read it. I was not satisfied enough with it. it can do some math sometimes, but then still I have this feeling like I want to double check, so I end up still spending the time on it. I guess I still need to build trust with it. What I use AI a lot for is just to correct my English. Sometimes I read my text and I feel like something is not running well. It's not nice to read.
Yeah.
And then I just say fix my English, and it does it really nicely. Then I need to take all those, because what it does nicely, when you say fix your English, it respects your writing style. If you say improve English, you get this fake style that everyone knows it's AI driven or something like that. I hate that. I hate it when I read emails from this. But just sometimes where I can say like, fix the flow of my paragraph, that's really helping me here. So I use it mostly for that, like fix my English.
Yeah, I mean, I can see some benefits with like the call transcript. If you say summarize this, and you don't want to read all, and probably nicely summarize first. I think with AI, if you're going to ask it something like, "What's the 5 most important things?" How is that meant to know what the 5 most important things for you are in that report? It's not going to know.
But my issue is, like, as an analyst, you can't outsource your reading to something, because I don't know how you learn, and maybe it's because I'm from this generation, but I internalize by reading and by speaking about it. So when I see summaries, I don't remind it. It's, you know what it is for me? It's the same when you drive somewhere and you either use Google Maps or you try to figure out yourself how to get there with a map, a paper map. When you do it yourself with a paper map, you will remember, because you had to put a mental effort in it to get to a certain destination. Yes, you may have been 3 times divorced on the way there. That's another story. But if you're using Google Maps, how often did you had to go to the same place and there are 5 times driving there? You think like, why am I still using Google Maps?
Yeah.
Because you don't pay attention to the environment, to the landmarks, and anything. For me, it's the same with reading an earnings report. You can't outsource. At least when you have my learning style, you can't outsource this.
Yeah.
So for me, the best thing, Control F.
Yeah.
If I want to know something, did the CEO say something about this? Control F through the transcript. That works the best for me.
Yeah.
And then I read the whole context above and below it.
Yeah. I think the second part of the question then is around any tips with it. I mean, I don't really have tips for financial reports now because I don't use it, but I am part of the AI task force team in my own workplace. And one thing that I've learned is the prompt that you ask matters.
A lot.
It really does. So you just need to find a prompt or something that will work for you, and it might not work the same on all financial reports, and it's different, but the prompt will
but at work, if the question was about work, it's different. For there, it's a total game changer in my field. The productivity enhancements are really strong.
But if you are short in time and you sort of like you have 40 companies in your portfolio and you just want to skim through it, you could probably upload.
Probably yes.
Give me X, Y, and Z from this, and then you look at it and
true. I think it has a lot of potential. I am just, I'm a person, that very much, with the design of the website as well, or when we write the newsletter, I pay a lot of attention to the details. And if I find out of the 100 things, 1 or 2 things that are wrong, I will read everything again. And I had that too often with the AI so far. So I don't feel comfortable with, not entirely. I guess I'm a control freak when it comes to the data.
Yeah. And I do have an issue with AI as well. It's not completely correct. We have a question later on about a company, and I read it after this question. So as a test, I asked AI about this company, and it came back to me and said it doesn't pay a dividend. So then I went into the investor relations, and it turns out it was wrong. So AI was wrong on that. So but we'll get to that later on. We'll get to that later. The next question then we have is from Richard, and he's saying that his SIPP, which is a pension, I believe, in the UK, is managed by a wealth management company. It cost me 1% of my principal each year for basically feck all activity and service. It's a real Irish way of saying it. I've been in the same 7 funds for 3 years, and I get one 30-minute video call a year. So have you or any of our members taken control of their own pension pots and self-managed?
I wish I could. I wish I could. For me, I mean, I would love to do this. I mean, you know what's even the worst? We have such a pension stuff somewhere. I've got also somewhere an investment. I can touch it. Every time there's some money coming in there. And then it was 3 years ago, I looked at the index that I'm investing in. I don't even count it for my portfolio because I knew I may never get it. I don't know. They had a 3.5% management fee plus transaction fee and everything under it. It's a scam. I can't make anything else of it. That's the issue with retirement funds, right? They know that there is a lock-in and that you can't get out of it. And in my case, I can't get out of it. I hate it. I really hate it. And don't let me even get started about the social contribution that is being deducted from my salary each effing month goes to the government here. And I believe in the UK, there is even a speak of that they want to modernize the pension system, but effectively, you know that the government is going to play with your money.
Yeah.
And it happened in the past, I believe in Poland, from what I understood from friends of mine, like a while back. You need to have a lot of trust in your government that they make the right decisions. And if you think about the Dutch pension system, it's one of the best in the world. I know that it has not been performing for a very long time. And I know that they are also totally reshaping it. I don't follow anymore exactly the details. I believe it's making it more personalized. But what I would prefer something where you pay rather a minimum that is the same for all, like the same as a minimum social welfare benefit that you get. Let's say it 1,500 per month, and that means every citizen pays the same. And then on top of that, you can invest it in a 401k fund or something like that, and it's yours. At least people that can't manage money and squander anything are protected because they get this 1,500, which is linked to the inflation index. Yeah, which means that people are not in poverty, and the others that are a bit smarter in money, they can probably feel more accountable about it, but also feel more responsible for it, and hopefully just put it in an S&P 500 index, and you probably outperform most of the pension funds by a large.
Yeah.
That's what, if I would be a politician, I would go for that, because now it's just 10% from my salary. God knows if I ever see it. Yeah, I hate it. I really hate it.
Yeah, and I understand Richard's pain here. He's paying 1% of his principal and seemingly not getting anything back. But I think if we're going to answer his question directly, he doesn't mention what returns he's getting off of these 7 funds. Is it matching the S&P 500?
Yeah.
I mean, because some of them do, depending on what the allocation is. So if you're tempted to manage it on your own, you're giving up 1%, but will your returns be less, or do you think it'll be more? Or I would say for the majority of people and who these pensions are aimed at, paying 1% is actually fine, because they're not going to go out and do it themselves anyway.
Yeah,
so it's it's better to have that pension there and have something behind you, and then when you retire, have something to fall back on, then to have nothing at all.
But this is also the issue that we have in society.
Yeah,
because it also takes accountability away from the person.
Yeah, it does, and there's many reasons for that. I mean,
and then we go quickly into politics. And that's why I said that will be my proposal of a solution in an ideal world.
Yeah.
But
the question here is, would you go self-managed in a pension? And
I would.
There's pros and cons. Personally, I'm not with my current pension, because if I did that, my workplace would not subsidize what they subsidize now. And
they should, of course, continue doing that. But the only question, the real mindfuck is, would you do the same for your wife? Yeah, imagining that you would die, would you leave your wife with your portfolio then,
Yeah,
or rather have her pay this 1% and not worry about it?
it's funny you asked that because two questions down. I don't know if you've read. Kay Jansen has said, "Let's say something happens to you. Do you have a person that knows how to manage your portfolio both in the short term and long term?" And honestly, my wife would not be able to do it, and I would much
No.
rather it be in a managed fund,
Yeah.
and she would not have to worry about it. Personally, my son, teenager, he knows
Yeah.
how to use brokers. He has his own brokerage account that he uses. But could he
Yeah.
manage a portfolio the way I do it? No, absolutely.
No, I have
absolutely.
I have also nobody, but I was thinking about it. And maybe someone has it, but I wanted to write kind of an instruction for my wife and my kids, like the philosophy behind it. I mean, read my blog, but then like what to do. Yeah, touch it or not. Yeah, what to touch and what not. Yeah, I was thinking about that. So maybe it's a request. If a reader has something like that and is willing to share it with us, maybe even just throw it in Google Translate if you did it in your own language, I would be so happy to see that. Yeah, because it really, really helped me out. I don't know really where to start.
The instructions will be easy. There's the withdraw button.
Yeah, but it's really a simple one. No, but a really simple one. Yeah. How do you log in to the account? Because you have two-factor authentication, and with two-factor authentication, you need to use your face.
I know I have something. I have something there for my wife on how to log into all my accounts.
Yeah.
Yeah.
Okay. Oh, so I have actually security issue then if she can do that, like to all your accounts.
Yeah, but she hasn't got access to it yet, but I have it in my will. And
You have it in your will, but I hope
she
you don't change your password in the meanwhile.
I did. That's my security measure.
And
But no,
then the guy, the notary, is like, "Yeah, let's try again." And then after 3 times, yes, your your account is permanently locked, and you need to do two-factor authentication for your email to get in. You're still screwed.
I'm sure to figure it out. But yeah, no, I think it's important for them to have some sort of guidelines on how to log in and what accounts that you have.
Yeah, because I have
don't have.
experience with that. When a family member died, we couldn't access the account. I mean, I could it because I kind of have worked in IT, so I could go to the memory and I could go to the history of the websites the person visited, and I was able, because the person had it auto saved, and then via the mobile, I was able to retrace everything. But the others felt like I was an Einstein that I was able to do this. Yeah, so I think for the regular Joe, it's really hard. Yeah, and how do you know what you don't know at that moment in time?
Exactly. Yeah, it's a tough one, but it's because it's an unplanned event, so you can't you don't know when that's going to happen, so you have to have something in place, I think, beforehand. So, but I'd be interested,
Yeah,
as you said.
and the brokers have no incentive. Yeah,
No, and I don't want it to be difficult. I want it to be as easy as possible. And
yeah.
if they don't want to invest it, I mean, at that moment in time, it's their money, so
Yeah.
I won't
Hey,
want
but
them to manage
I
it.
could manage your portfolio. You could just give all your login details to me.
Yeah, and you'd sell all
You
my
you,
shit.
you trust me, right?
I would trust you to do the right thing. I would, 100%. Sell.
I would sell the most risky stocks in your portfolio, like everything.
Yeah, I was waiting
Like
for
Vici, out. I don't like casinos.
that. Every sin stock out. British
Every
American
since stock
stock
out, nothing left.
Yeah.
And your wife will be like, "Whoa, you know, at least I met a guy now with
Yeah.
moral principles."
Why do you just have Ahold? Why is everything else gone? Just Ahold is left. Carlos has asked us a question about BDCs, talking about high risk portfolios. They offer high yields and have grown immensely lately and seem like a safer and more sustainable industry right now.
Yeah, I don't understand them. business development companies is really hard for me because you need to have a bit of an understanding of what businesses they are investing.
Yeah.
Because effectively these are investment vehicles, and it's I don't have a feeling for it. I must confess I've never also really put an effort behind it to really get to understand them. I believe Maine is one of those that always pops up. I looked at it in the past one time. It was quite okay what I saw, but it didn't really give me a feeling like, okay, now I need to throw my hard-earned money into it.
Yeah.
I rather threw it in Tupperware.
Yeah. I think understanding him is key. I'm not that's not lost to me what you said either, but I think with BDCs, I'm not an expert in that field, and I think you're right. A lot of people are talking about Maine at the moment, and that's what scares me a little bit, because normally when I see one company repeatedly coming up on Twitter all the time, I get scared, because we've seen it with lots of different companies, and how that goes. And this is the company that I have been seeing, I would say, a lot lately. And the question I would have to people is, do you actually understand what that company do, how they make their money, what risks they're exposed to? Yes, they have a nice dividend yield. Yes, they have a nice dividend history. But what risks are you exposed to? And I can see the interest behind BDCs because it's high yielding. I like having a high yielding portfolio. So it's something that does interest me, but I haven't, like you, I haven't put the work into that yet. And I'm not keen on just following the crowd because it's the in thing at the moment. So I prefer to do my own work on that. But I know Dividend Bull speaks a lot about these on his channel. He does overviews of them as well, so probably a better place to look. But it's on the finger. It's a long finger at this stage, but eventually I will get time and sit down and understand these companies. JVDK, do you have positions in all 11 sectors?
I am thinking, because I thought not telecom, but is Google not a telecom company?
Or Google could be telecoms, actually.
Yes, Google is, because I've classified this an informatics technology company, but wasn't it a communication services or something like that? I don't know.
Yeah.
Maybe if anything, I've got a few shares in Google. But I would need to look that up, what kind of sector it operates in.
Yeah, I think I have a couple of shares. Oh no, I don't actually. I've sold. I had a couple of shares of Verizon, but I actually sold that because it was only 4 or 5. So I don't have telecoms. I think I have everything else. I have materials, industrials, pharmaceuticals. Yeah, 10 of the 11 I have.
Nice. Yeah, it's a sector communication services is Google.
Yeah.
So I technically I have.
You have all 11. Nice. Yeah. Centrino has asked us about UK wind. The price keeps dropping. It's nearly an 8% dividend yield. We know that they increase at least at the rate of inflation, 0% withholding tax. Did you make a calculation of its fair price? And I think what's important to know is that this is an investment trust, and you can do your fair price calculations, but what really matters is the NAV, net asset value price. And what also matters is, are they trading at a discount or a premium to that net asset price? They are currently trading at an 18% discount, right? And that matters because if they're trading at discounts for prolonged periods, it could limit their access to funding, shareholders get kind of up in the heap, and so on. And each of these companies also have these wind up provisions. So if, and this is their own policy, if they are trading at a discount to NAV of 10% for more than a 12-month period, they have to put this to a vote to the shareholders whether they will wind up or not. They're trading at a 20% discount. They've been trading at that for quite some time, so it is not unlikely that this would go out to shareholders. Do I think they would wind up? No, I don't. However, if you have to look in that industry as a whole. It's been struggling over the last while. A lot of their income comes from government incentives. I looked at a couple of solar in trusts last week or the week before. One of them was this company called Ataro, really good company, all about rooftop solar panels. I thought, great, this company looks actually ideal. Turns out they wound up and were bought by Brookfield Asset Management. So it is a possibility. It's not like it can't happen. So I think you just have to be careful with that. In terms of fair price, look at the net asset value here. It's trading at a discount. Why is it trading at a discount? And make a decision for that. So there is some risks here. I need to highlight that. I know I speak about this company trust. I do like it a lot. I do believe in the energy transition, but it doesn't take away from the fact that investment trusts have been in a challenging environment over the last couple of years. The discounts have been quite wide. They're starting to narrow, thankfully. 20% is a really high discount. So the chance that this company could wind up or someone else sees the opportunity to buy their assets at a lower price is quite real.
I like how you said 10 times wind up.
Wind up. Yeah, because it is a risk. It is a risk.
Yeah, but I mean, UK wind winds up.
Wind
You're right,
up.
it's the same, right?
Wind up. Yes, I get it. Yes.
Yeah.
Wind. UK wind up.
Yeah, you see, I'm a bit jolly today. Yeah, this is a question for you. We spoke about it a bit about the dividend hike, but El Kuba is also asking about your thoughts. But I think we addressed it a little bit. Anything else you want to say about it? Like, for instance, are you interested in their healthcare division?
I have to look deeper into Siemens. The healthcare division doesn't interest me as much, but I'm biased in terms of my industry. Electrification, automation is my main interest. But look, overall view, results were good, positive. So yeah, nice.
Good.
Connor has asked about our thoughts on DCC. They've announced that they are looking at selling the health and tech segment of their business.
Yeah.
Their share prices jumped on this. What are your thoughts?
I can only confirm that the share price jumped. I saw that yesterday. Very interesting. But Connor, I really need to look a little bit deeper into it and make up my thoughts about this. So it's a bit too early for me to say. But Connor, if you have already looked into it, let me know what your thoughts are. So in essence, as far as I know, is DCC will therefore double down on energy. And the question is, does that matter? Is that a good thing? I don't know yet. I need to think about that.
Matthias, what are your thoughts on T. Rowe Price capital allocation strategy? Would it not be more wise for them to reduce their share count at these prices?
There's I think it's not about wise. It's probably more about smart. It would be smart to do that, but wise would be to understand your shareholder base where a lot of people are depending on the dividend and are invested for the dividend. So to suddenly change your capital allocation policy would create unreliable management, and I think it would do more harm probably to the company, specifically in the short term. Yeah, because you get the shareholders you deserve. So smart, probably yes, if you look at optimal financial allocation, let's say. But I'm in it for the dividend. If they would go purely on the buyback spree, I would probably sell it because I'm not a total return investor or value investor as such.
Yeah, but they've got obviously they've got a rock solid balance sheet, but they've got the cash, they got the cash flow. So it might not be the worst idea for them to do that. But again,
but not cutting the dividend. If they cut the dividends,
you have to cut the dividends.
Yeah, that's what this is suggesting, right?
Is it? Oh, I don't think so.
Well, if you want to buy 13% back of the share count, that means the shareholder yield. Yeah, entire shareholder yield, including the dividends. So.
The next question is from Dionis. What do you make of Bayern's quarterly report, latest report?
Can we skip?
Yep.
This is such a shite. I mean, the CEO there. Oh boy, what he inherited. I mean, it's like there comes a dead body. Uh, there's a dead body behind every door he tries to open. I mean, it's unbelievable, Derek. It's really unbelievable. Yeah.
You can tell you're passionate about this one. Yeah,
Yeah.
it's
I
once,
think I answered the question, Dionysus.
yeah. Blame Monsanto. Blame Monsanto.
Yeah.
Philippe has asked any consumer staples you would recommend looking into beside Ahold Delhaize. I think we mentioned I did Target there a couple of weeks ago. I think Target are a
Target
company.
is interesting.
Yeah.
Yeah.
And then maybe Greg's, I like Greg's as well in the UK. There's actually quite a few in the UK that you might be interested in, but yeah, targeted Greg's would too, I would say.
Yeah, you've got Kroger, you've got General Mills,
Yeah.
in the States that are also interesting, I think, to look at.
Adrian has asked our thoughts, but my thoughts on Nomad Foods, ticker symbol NOMD. And this was the company earlier that I said I'd go into ChatGPT, see what it gives me back. And it told me that they do not pay a dividend and they don't pay their dividend because they're paying down their debt and so on. I go on to their investor relations and they are paying a dividend. Now, albeit they've only paid in 2024, so they've only paid 4 quarters, but it still just shows me that maybe AI is not completely up to speed. And I know ChatGPT has its limitations in terms of where it gets its information from, but that's what I would struggle with AI. But going back to the question, Nomad Foods look like a really good business. They have some good brands. I don't know if Bird's Eye is popular over in Europe, but it was popular in the UK.
I have no clue what it is.
You know, it's like frozen foods, and Bird's Eye was a brand of
Okay.
that. I've an ad sing in my head, but I'm not going to sing it because I won't bore my listeners. But I thought it was a really good company. They've seen some strong growth. They're expanding a lot into Europe, but they've only initiated their dividend in 2024, so it doesn't meet my criteria. I don't know how safe that is. I don't know what their policy is, and given that it's so young, it's not something I want to spend my time into. I can see the fascination with them, or why you would look at a company like that, but it's too early in their dividend history for me to entertain. Eric Mead has asked us about Airhorn Hedge Fund, new investment in Europe. Any thoughts?
I'm not aware of it, Eric. So I really would need to look into this. And as we are recording a bit early on Thursday, I really didn't have a time for that.
Yeah, I tried to find something and nothing quickly popped up. I know, is it David Ihorn is like this elite or famous hedge fund manager, but I don't know what this new investment is in Europe. Honestly, I don't. If I try to find something quickly, but I'm obviously not looking in the right places. So maybe send a link, Eric, on Facebook. That's where we got the question, and we might read up on it a little bit. And then the final question goes to Tim. With companies like Louis Vuitton and L'Oreal dropping, do you have a strategy for dollar cost averaging down into these companies?
Yeah, so I typically, because he asks every month to buy a bit or every 10% drop, I usually do like every 10% drop. That's usually what I do, because I usually buy something different every month, but over time I'm DCA dollar cost averaging in, and that's usually via the 10% drop philosophy.
Yeah. Good. Nice one. That's it. Thanks to all our listeners for all the questions. Eric, if you can drop that link, so I'll be interested to read that. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.